Welcome to the Kapital News. I am your host, Alex Karitis. Today is Monday, December 21st, 2020. Thank you so much for joining me. The title of today's podcast, Nobody Cares Act 2.0. My apologies for being away for the past, couple of weeks already. I was actually in quarantine. Had some symptoms. I said, okay, better safe than sorry. Let's go get it checked out. Came back negative for COVID-19 and for the typical flu, but was still told for necessary protocol. Quarantine for a couple of weeks. We're going to take another swab. We're going to send that one out. I guess there's a lot more accuracy with the rapid test than what there used to be, but still, they still take a secondary test just to make sure. They said, okay, well, it's going to take about 5 to 7 days for that to come back. Of course, it took a little bit longer than that because I guess the influx of tests that the lab has been dealing with. But I got a phone call this morning from my doctor's office saying, oh, yeah, you actually had COVID-19. So I really don't know what to believe because they even said this was very rare. They said they've only come across a couple of these cases, meaning somebody would test negative on the rapid test, which I did. You get your results back within 20 minutes. But then when they send the secondary test out, it comes back positive. So I don't know what or who to believe. I'm just thankful that I feel fine. I never had any serious symptoms, if you will. A couple aches, fever coming and going, but that was it. Still had taste, smell, all that stuff. But still, you want to play it safe. You want to go get checked out. So I just thought that was interesting to get the rapid test negative, which was obviously good news. And then to hear today, well, yeah, good thing you quarantine. I guess you're out of quarantine now officially, but you did test positive. So I don't know, again, who to believe, but that was the results. That's why I have been away, just playing it safe. Most definitely did not want to be away, especially for this long, but got to do what you got to do, I guess. But very glad to be back. And surprisingly, and this is all thanks to you guys out there, I thought my numbers would have tanked. Not that they've done great since I haven't done these things daily, obviously, but the numbers were a lot better than what I thought they were going to be. A lot of people still checking into the Kapital News, still listening, going back maybe and listening to some older podcasts, or perhaps just some people just coming along. So thank you very much for keeping the numbers up, and hope to be healthy the remainder of this year and well into next year to keep doing these things because there's a lot going on, to say the least. I mean, the last podcast that we did was 2020, the year that will live in infamy, and we covered a lot of topics on that. Really just provided a list of things that we have experienced through 2020 and some things that are going to continue to unfold through 2021. And for those of you who have been with me know well that I believe 2021 is unfortunately going to be worse than 2020. I hope I'm wrong in this, but I just don't see that being the case, especially when it comes to the economy. We are in the midst of the Greatest Depression, make no mistake about it. And of course, with today's headline, Nobody Cares Act 2.0, this is just going to be a further continuation of these terrible policies. No leadership, no responsibility, no accountability, par for the course. So they're just going to continue to spend and print and borrow and beg for money that we do not have, driving up our deficits, driving up our national debt, which of course we'll talk about a little bit more. But this is most definitely the Nobody Cares Act 2.0, and I imagine there's going to be 3.0, 4.0, et cetera, as we make our way through 2021, because these are not solutions. These are Band-Aids on a gunshot wound. These are kicking the can down the road. It's all it is. Again, because there is no responsibility, no accountability. These politicians do not want to go back to their home districts, look their constituents in the eyes, and tell them the truth as to what's really going on here, and that these policies do not work, that the policies that they have been managing and passing for the past several years, if not generations, because it's the same song and dance, do not work, will not work, and we have to do something different, but it's going to be painful, and of course nobody wants to deal with any type of pain, even though we're still dealing with it. So that's what we are dealing with. So of course, being away for a couple of weeks, a lot has taken place. The only couple of things I really want to talk about today are Nobody Cares Act 2.0, some market performance. Federal Reserve, the Federal Open Market Committee, met for the final time, at least formally, last week. So I want to talk about those comments from the chairman of the Federal Reserve, Jay Powell. Some bank stress tests getting approval. Everything is checking out, I guess, perfectly fine for the banks, according to their regulator, the Federal Reserve. What does that mean? Because now they get the go-ahead for more share buybacks. Oh, good for them. And, of course, being away for a couple weeks, we missed our typical Thursday conversation where we go through initial jobless claims, Federal Reserve's balance sheet, and money stock. And, of course, we have all-time highs with respect to money stock, with respect to the Federal Reserve's balance sheet. And, unfortunately, the past couple of weeks has been a reversal with respect to initial jobless claims. We were seeing a steady decrease over the past few weeks. But then, last week and the week prior, two doozies of a number, which is not a surprise to us here at the Capital News. We said this was likely to happen, especially with all of the lockdowns and further restrictions that were coming. And just a lot of the money making its way through from Nobody Cares Act 1.0, it's just starting to dissipate. It's losing its punch. I mean, when you throw trillions of dollars into a system, you are going to get an effect, okay? But it's going to wear off. And that's what we are in the midst of. So that's where we have 2.0. That's why we have the economy continuing to slow down. And you're finally starting to hear a lot of the mainstream news, especially on the financial media starting to come around to what we've been stating here for months, that this economy is weak, that it is not a super-duper miraculous V-shaped recovery, no way, no how, and that now they're starting to predict a double-dip recession. Well, we never came out of the first one, folks. So this double dip is just a bunch of nonsense. It's for these idiots to cover their rear ends. That's all it is. They'll justify, well, there was a huge bounce back in the third quarter with well, it's not just GDP that dictates a recession. We know this. It's a whole host of data. Nothing has bounced back to sustain itself. This is not a double dip recession. We never got out of the first one. This is the greatest depression. I take no pleasure in saying it, but that's what it is. A lot of people wanted to continue with the hype. They wanted to continue the optimistic tone of the Trump administration, of CNBC, Fox Business, Bloomberg. Oh, yeah, this is the greatest economy ever. Before COVID-19, everything's great. The economy's never been so strong. A bunch of nonsense. Flat out lies, propaganda. Yes, it's optimistic. Yes, you want to believe it. I get it. But I'm not here to lie to you. I'm not here to push fancy narratives. I'm here to give you the hard facts, the data. That's it. And then to make an analysis, to put together my analysis, my opinion. And we're pretty good here. Most people said everything was going to be fine. Well, then why did we have contraction in the first quarter of 2020? Because COVID-19 really didn't start taking full effect until the latter part of the first quarter and really into the second quarter. If everything was great, well, surely it should have been strong enough to keep some semblance of positive growth, but that wasn't the case, was it? No, it wasn't. And now they're talking about the same thing once again going into the first quarter of 2021, that everything's slowing down and that there's going to be a double dip recession. That'll be the headline. That'll be the narrative. Don't be fooled by it. We never got out of the first one. Never came out of the first recession technically and officially, and we're not going to come out of it for a long time because we are in the midst of the greatest depression. So here's some market performance. The dollar index trading at 90.275. Of course, when I was away, it was south of 90, trading at an 89 handle. And you had a lot of pundits, at least some of the people that I follow on Twitter or YouTube, starting to say, oh, the dollar's cratering. It's finally collapsing, this, that, and the other. Hold your horses. I told you the number you got to pay attention to that's cause for concern. When we get to that 87 handle, then it's cause for concern. Because if it hits 87 and it keeps going down, then something bigger is afoot, something bigger is at play here. Then it's something to really start paying attention to. But nonetheless, it has been on a continuous downward trajectory. Again, the dollar index trading at a 90 handle. And a lot of weakness with respect to the dollar across a lot of the major currency pairs. But that's where we are. On the overnight futures trading, let's see some action here. We have the Dow Jones Industrial Average down 0.5%. The S&P 500 is down 1/3%. The NASDAQ 100 is in the green, up about 0.1%. Cash trade in Japan is currently down 0.9%. A big sea of red across the pond in Europe. UK exchange giving back 1.74%. German markets giving back 2.8%. French markets down 2.5%. Same with the Italian markets. And the Spanish markets giving back a whopping 3% for the day. This is off of the back of further restrictions. And now, of course, we have the vaccine, right? But hey, that was for a certain strain of COVID-19. Now they've already come across another strain of COVID-19, and it's really, I guess, taking a foothold in the UK and having ripple effects across Europe. So you heard it, right? You get the vaccine, and then as soon as you get the vaccine, you get another strain of COVID-19. So I guess we know what narrative they're going to continue to push throughout the remainder of this year and 2021. So pay attention to it. Australian cash trade is also currently in the red, giving back 1.3%. On the share front, we have Apple gaining 1.25%. Tesla, first day trading on the S&P 500, is down 6.5%, trading at $650 per share. You know, this is one of the largest companies in the world somehow, and it trades like it's a penny stock. I mean, if you follow the pink sheets, if you follow these penny stocks, you know, you wouldn't be surprised to see fluctuations 4, 5, 6, 7%, 10% on a daily basis. They're pennies. Okay, it makes sense. For a company that is supposedly one of the largest in the world here with Tesla, at least with respect to market cap, up 6%, down 6%, up 7%, down 7%. This market is busted. This is not how this is supposed to work. Okay? So we've seen this song and dance before. We've seen the .com era. We've seen Cisco, CISCO. We've seen Yahoo. We've seen a lot of companies back in the .com era get added to these big exchanges, get added to the S&P 500 or what have you. And then we see what happens. Huge collapses, 70, 80, 90%. It's happened before. It can happen again. Microsoft gaining about 2% for the day. Amazon relatively flat. Facebook, to round it out, giving back 1.3%. Now, last night, there was obviously talk about Nobody Cares Act 2.0 really coming to fruition. And you would think, well, if this is really stimulative, right, wouldn't you think that commodities would take off? Well, that didn't happen. That didn't happen. Oil gave back, and it gave back a few percentage points. And it continued throughout today. WTI, is currently trading at $47.50 a barrel. Brent is at $50.49. Natural gas hanging on at $2.70. Gold and silver were both doing very, very well overnight. But then when it comes to the day session, not so hot, but still in the green. And silver still moving up nicely, breaking out of a channel, so we'll see if that gets sustained. But we have gold trading at $1,878 an ounce, and silver trading at $26.26 an ounce. Those are spot prices for the precious metals market. And to round it out, Uncle Sam's 10-year junk note is yielding 0.93%. 0.93, still range-bound, but flirting with that 1% figure nonetheless. We'll see if we get there. Of course, the Federal Reserve doesn't want that to happen. I mean, they're fighting the inflationary fires with more inflation. That's all they're doing. That's all they can do. The only tool that they have is a hammer, so everything looks like a nail. You know, I believe it was our first Capital Economics video presentation that we did. Of course, it's posted on all our stations, everywhere we post our podcasts. And, of course, the capitalnews.com. But we just simply asked the question, are central banks trapped? And the answer, of course, is yes. They're trapped by their own doing. But that's not going to stop them from coming out with their propaganda on a weekly, monthly, daily, whatever, daily basis. However many times they want to put out a press release, they're going to do it. They're going to say that they are the titans of industry, they are the gods of finance, that they can solve any problem, that they're never out of ammunition, that they can always do more. and they'll just make something up. Whether it's some sort of BS emergency facility, whether it's some scam, whether it's just rebranding of something that they already do. And of course, there's never going to be serious questioning of them, not by our politicians, not by our elected officials who are supposed to hold them to some type of account, right? This is supposed to be a system of checks and balances, at least something. They're not going to hold them to account. Well, what about the fourth estate, right? What about journalists? What about the media? Surely they'll ask tough questions of Jay Powell and other members of the Federal Reserve. Of course not. Why would they do that? Then they're not going to get interviews with them. Then they're not going to come on Fox Business. Then they're not going to go on CNBC anymore or Bloomberg. Got to play nice. Can't ask tough questions. You can't criticize their policies. You can't put your country ahead of your career or anything like that. You can't ask some basic questions. No, you can't do that. It's all softball. No follow-ups. And of course, now, because they don't do it in person, they do it all WebEx or whatever you want to call it, off a Zoom press conference. They don't like the question. They'll just shut you down. You can't really press them. Can't do a follow-up. So it's nothing. It's just a joke. It's just a continuation. Yeah, we're going to print money and to whatever degree we want. And you can ask questions, but we're not going to answer them. We don't care, and you're not going to stop us. Doesn't matter what data you throw at us. If somebody really grows a spine and asks a tough question, they don't care. They'll just dance around it. It's what they've done. It's what they will continue to do. One of the interesting things that Jay Powell said last week, somebody I believe did ask the question with respect to stock valuations, and of course they are record territory just across the board. I mean, 1929.com. Anytime stocks were this highly valued, those are the periods of time you have to go back to get any type of reference. And they're even worse now. But that's just if you want to understand how overvalued these stocks are. Got to go back to 1929, got to go back to the dot-com bust. That's where we are. And it's worse, and it's getting worse because they continue to fuel this. But nonetheless, he was asked the question, do you think stocks are overvalued? And they're talking about the PE ratio, price to earnings. Many of you are familiar with this. One of many metrics you can look at when valuing a stock. And he said, well, no, they're not overvalued. They're not overvalued, according to Jay Powell at the Federal Reserve, because interest rates are so low. So because interest rates are so low, these types of PEs are completely justified. So if they're justified, then they're not overvalued. But then I guess nobody seems to want to ask the question, well, Mr. Powell, why are interest rates so low? I mean, is that a good reason? Is it a good reason why interest rates are so low? See, you can't have these follow-ups. You can't have these basic conversations with these people who are supposedly our quote-unquote leaders. You can't ask anybody in power any serious question. So, of course, he's not going to say, oh, yeah, stocks are overvalued. He's not that stupid. He's not that stupid. I mean, that could cause a 10% sell-off like that. If he would have said, oh, yeah, stocks are really overvalued and something we're seriously concerned about. But you know what? If you actually read, I know a lot of people don't do this, of course, but if you actually read a lot of the reports that the Federal Reserve puts out from time to time, they do tell you, they do caution that asset prices, that financial asset prices are a little bit frothy. They mentioned this a couple years ago, into the lead up to the fourth quarter crash in 2018. They mentioned this, the Federal Reserve. They did. You just have to read the reports, but nobody wants to talk about this stuff. They talked about it last year, and they're talking about it again. But they don't say it in their press releases. They don't do it in their press conferences. You have to go in and read a lot of these reports that they put out. Now, it doesn't mean that there's going to be a market crash or even a correction, but they do admit to it. But you got to go digging for it. The other thing that the Federal Reserve comes out and says, oh, well, all of the banks, they the large banks especially, because that's really all they care about, they pass the stress tests. They pass the stress tests. Earlier in the year, they didn't pass the stress tests, and they were put on restriction. They were put on a strict diet. Can't do share buybacks, can't do XYZ. But now the big boys are passing with flying colors, and now they are allowed to repurchase their shares. They can go back and implement their share buyback programs. And on the same day that the Federal Reserve released this, I'm pretty sure it was the same day, just a couple of days ago, last week, J.P. Morgan Chase announces, oh, fantastic. We are going to implement a $30 billion, with a B, $30 billion share buyback program. $30 billion. How many people has J.P. Morgan laid off this year? How many people are they going to lay off this year, what remains of it, and next year, and even going forward? Because $30 billion, I imagine, could keep a lot of people employed. $30 billion just to buy pieces of paper to put them off, to write them off, basically, to retire those shares. That's all. There's no true economic gain from this. This is financial engineering to juice the price of the stock, and it has done so. Actually, I think their bank shares did well again today. Yeah, J.P. Morgan Chase was up 3.75% today. Off of the back of this news, and just, everything's just perfectly fine. And of course, why were these banks capable of passing the stress test? Well, they were capable of passing the stress test because they got bailed out by the Federal Reserve. The same institution, the same regulator that just said, yeah, you passed the test. You can't make this stuff up. This is a first world banana republic, folks. How much more, again, evidence do you need to see? It's so disturbing and disgusting, it's not even funny to me. But the reason they were capable of doing this, yeah, of course they got the bailouts, but it's more than that. It's the direct bailouts and it's the indirect bailouts that the Federal Reserve gave to these banks. Because so many companies out there issued new debt. And the reason they issued new debt is because they knew that there was going to be a buyer out there. Well, of course, these companies, they have to have it underwritten. Well, who does that? Who does the underwriting? These banks do. Who trades in the fixed income market? Well, the banks do. Well, you have an insurance policy written from the Federal Reserve saying, oh yeah, go ahead, take out as much debt as you want. Banks can do all the underwriting, they can trade in it, and they're going to be perfectly fine. And if something goes wrong, don't worry. Because the Federal Reserve is going to come in and backstop it. So if things go south, don't worry, you'll have a buyer for that paper. Wink, wink, it's going to be us, the Federal Reserve. And of course, if the Federal Reserve should fail and things continue to go south, well, the Federal Reserve doesn't have to worry either. Because they're backstopped too. Well, who backstops them? We do. We do. The average Joe and Jane. John Q. Public, the taxpayer, does. You see this game? And now we have Nobody Cares Act 2.0. A $900 billion monstrosity attached to a $1.4 trillion monstrosity. So I guess the $900 billion is supposed to be this new level of stimulus. Of course, it's not stimulus, but that's what they call it. And then the $1.4 trillion is just a typical spending bill to keep the lights on for a few more months. And that's all it's going to get us, folks, is a few more months, $1.4 trillion. But in this $900 billion piece of crap, known as the Nobody Cares Act 2.0, I guess we're going to get another $600. Those making $75,000 a year or less will get a $600 check. Couples making less than $150,000 will get the checks. That's half of what it was earlier this year at $1,200. Now it's $600. I guess an extension of unemployment benefits, at least through, I guess, the first quarter of 2021. So there's going to be further distortionary effects there. Tens of billions of dollars, I believe, to the airline industry. Billions of dollars given to, I think, the movie theater industry. I think the restaurants are still beggars, if you can believe it. restaurants, one of the hardest hit of anybody, I believe, I could be wrong and you can correct me, but I do believe that they are not receiving any type of direct assistance with this bill. I think it's going to take place, I guess, in another Nobody Cares Act version sometime in the future. So you have all that. Then you have all the pork and all the overseas spending. What an insult, isn't it, to the American taxpayer? Tens of millions of people unemployed, food bank lines, facing eviction. We know the story. And these jokers are going to pass a bill, 5,000 some odd pages, and in it, hundreds of millions, billions of dollars going overseas. And not for our troops or not for Americans overseas, just other countries. How can these people do this? And look at you in the face. Well, we know why. It's the Nobody Cares Act. They don't care about you. They don't care about you. Stop standing up for them. Stop sticking up for the Democrat Party. Stop sticking up for the Republican Party. And now, elections have taken place, who cares? So now, earlier this year, it was 96-0, no votes for America, 100-0, no votes for America. Now you're going to see some people miraculously have grown a spine. And you're going to see some people dissent. You're going to see some people vote against this. Don't buy it. It's a joke. All right, so there you have it. Of course, we get more details. We'll talk about it, but it's just another joke. $900 billion that we don't have. $1.4 trillion just to keep the lights on that we don't have. USDebtClock.org, one of our favorite sites. $27.5 trillion national debt. Fast forward 4 years. 4 years. 2024, another presidential election cycle. We're going to be at $49 trillion. It's just if we keep pace with where we are today. These numbers are so insulting, it's not even funny. But that's where we're going to be, and nobody says anything, and nobody cares. So, $900 billion plus 1.4 takes us to $2.3 trillion. U.S. federal tax revenue is about 3.4. Let's round up to $3.5 trillion. So we're already there. We're already there. So our deficit this year, it is technically the federal spending year. 2021, we're most definitely going to hit $30 trillion when it comes to the U.S. national debt. $30 trillion. And I'm not going to be surprised if it's more than that. And then to round it out, let's go through the initial jobless claims here somewhat quickly. Of course, it's old news, but I like talking about it, and I've been away, like I said, for a couple weeks. So I just want to make sure that we touch upon it a little bit. So for the week ending December 12th, initial claims seasonally adjusted 885,000. This is an increase from the week prior of December 5th of 23,000, an increase of 23,000. 885,000, again, initial claims for the week ending December 12th, getting very close to that 900,000 figure, something we haven't seen for quite a while. When it comes to continuing claims for the week ending December 5th, recall there's a week lag. We have 5.5 million, a decrease from the prior week of about 273,000. Then when we look at continued weeks claimed for UI benefits in all programs, so that's everybody, regular state, federal employees, newly discharged veterans, pandemic unemployment assistance, PUA, pandemic emergency UC, PEUC, extended benefits, state additional benefits, and a work-share program gives us a grand total of 20.6 million. Again, this is for the week ending November 28th. This lags a couple weeks, but nonetheless, some big increases in some of these major programs. So regular state, we saw an increase of 552,000. With respect to PUA, we saw an increase of some 688,000. And with respect to PEUC, we saw an increase of 268,000. So you add it all up, week over week, it's an increase of 1.6 million. So for the week ending November 21st, we finally got below 20 million, and we were at 19 million and change. Now, for the most recent week, November 28th, we're at 20.6 million. So this is most definitely in the wrong direction. And with the Nobody Cares Act 2.0, an extension of some of these programs, 10, 11, 12 weeks, we're going to continue to have distortionary effects being played out into early 2021 and most likely beyond. I think there is an extension on some of the eviction moratoriums. But again, just kicking the can down the road. This is not solving any of these problems structurally. It's just saying, well, you don't have to pay your rent, but there's still no relief for the landlords. And a lot of these landlords are small businesses. I just don't understand how these businesses are going to survive. And of course, that's in agreement with what we discussed a couple of weeks ago with one of our small business pulse checks, where of those remaining small businesses that are still in operation, nearly half, 48%, claim that without further assistance from the government, they are going to close their doors permanently. Now, of course, within this Nobody Cares Act, they claim that there is further assistance for these small businesses, but we know how that first act worked out, and it didn't for these small businesses. We know where most of the money went. Even according to the Small Business Administration itself, most of that money went to bigger companies. So what makes us think that this time it's going to be any different? It's not. It's not. And that's why 2021 is likely going to be worse than 2020. And then to round it out real quickly here with respect to the Federal Reserve's balance sheet hitting an all-time high for December 16th, $7,362 billion. All-time high. $7,362 billion. And one of the largest week-over-week increases of some, we got? $120 billion from the prior week. Of course, they say everything's fine. Well, then why do they got to keep expanding their balance sheet? Why you got to keep buying further assets? It doesn't jive. It doesn't jive. And this is likely going to hit $10 trillion next year. So just a little, perspective. $10 trillion is about 50% of U.S. GDP. Okay? That's where we're headed. This is a banana republic. M2 money stock also hitting an all-time high, $19,226 billion. The week I was away, you actually saw a little bit of a contraction, but don't worry, it made up for it and then some with some $220 billion. And again, $19,226 billion. These numbers are so big, it's hard to even understand what's really going on. But nonetheless, these are metrics to pay attention to. With respect to M1 money stock, also hitting an all-time high at $6,584 billion. And then you just got to look this up, folks. I mean, Federal Reserve economic data, just a huge increase from a month ago. November 16th, we were at 5.7 trillion. Just a month ago, 5.7 trillion. Now we are at 6.5 trillion. Okay, so nearly $1 trillion added to M1 money stock within a month. This does not happen in a strong country. This does not happen in a strong republic. This is what happens in banana republics. Wake up. Pay attention. Stop supporting the Republicans. Stop supporting the Democrats. These are jokers. They don't know what they're doing, and they're making us pay for it. I'm glad to be back, but that's where I'm going to end it for today. Nobody Cares Act. Stay diversified, stay vigilant, and stay with the Kapital News. I am Alex Karitis. Godspeed.